Today, a Starbucks coffee costs you $350. Three Starbucks coffee in a month is 1,000 rupees. 1,000 rupees SIP over a period of 20 years at a a 12% return can make you a lakpati in millionaire, Indian millionaire. Yeah. But you have to have time with. If you don't have time, and if you're like, I'm already 50 plus, and then I'll invest for next 20 years, but I have a lot of other things to do.
Digital consumers want delightful experiences. Fast responses make your customer interactions a happy journey. Signzy helps you get more customers with advanced digital fraud check that scales. Making digital banking also as safe, secure, and compliant as traditional banks. Using artificial intelligence to bring human-like fraud detection to digital processes. Which also makes customers happy.
Hey folks, welcome back to yet another episode of Cash to Code. Today, we're super excited to host Srinivas Jain, who's the Executive Director and the Head of Strategy at SBI Funds Management.
With over 28 years of experience, he looks after digital transformation, product creation, and strategic growth for both retail and global investors. Srinivas has played a key role in the massive growth of mutual fund industry in India with campaigns like Mutual Funds Sahi Hai and surge in digital penetration.
Also, none of this would have been possible without the help and support of our partner Signzy. If any of y'all are looking for an identity verification or a customer onboarding tool, you know who to go to. With that, super excited to host Srinivas today.
Welcome, sir.
My pleasure. I'd also love to introduce our co-host for today. Amit today runs 77 Capital. You would have seen him in a couple of the previous episodes. Amit, welcome to the pod and really excited for the next 60 minutes.
Thank you.
Awesome. Srinivas, jumping right in, been 28 long years like I shared earlier. I'd really love to understand how the market back then, what did the market really like and what really pulled you into this segment 28 years ago?
Well, I mean, nothing happens by design. 28 years ago, it was, I was doing my chartered accountancy. I used to work for a firm which also had a broking as part of their business, and they kind of asked me, "Do you want to come and work with us?" And I had zero knowledge of the markets. I used to read newspapers, but I had no idea of the market. Something about the market kind of liked. It just felt that it's something different from accounting. Let me give it a shot. So I moved in, and that was just jump into the ocean. And those were the days when you look at the equity market. It was still manual, right? A lot of things were manual, and I was in Bangalore, and the Bangalore Stock Exchange. I used to go, and they were still shouting on the floor, and calls, the orders were taken. Those were the initial days, and then of course, you got NSE coming with digital, and DMAT happened. It was a highly speculative, largely unregulated kind of market. And then when I moved, I was in this small broking company. I moved to Kotak. I was one of the initial guys who joined the Kotak broking team. I was involved in stock broking, but largely I was involved in fundraising on public markets. I did a couple of IPOs as part of Kotak Mahindra Capital Company. So that gave me an exposure around how the capital markets work, not just the back end of broking. Then I was for a small stint, I joined ILFS's subsidiary called InvestMart. They were the first people to go fully digital because NSE had just opened up. And that was my first excitement on technology, or at least the fintech side of it. When they hired me to kind of be part of that initial team, which was trying to build a first digitally online access to equity market. But I did my initial learning on the terminal. So I used to be on the Odin and NSE terminal, trying to buy my customers and investors. And that's how I kind of got excited about technology. And that was a very short stint. And then I moved to the other side of the table, which is from sell side to the buy side, and I joined Birla Mutual Fund. I kind of set up the South region for that entity at that point of time. It was a smaller asset management company. Then something kind of came up around the career saying, really need to do. Today we talk about scale of democracy and what is possible by building something for big. And when SBI kind of approached me, I was very happy that the kind of impact you can create in SBI is much larger. So it's been 24 years in SBI now. I've been with SBI for 24 years, and it's been a great journey.
That is awesome. I was just brainstorming with Amit. I think in our generation today, we look for opportunities in an average span of maybe 2-3 years as an all-time high. 23 years seems 10x of that. What really made you stick around for that long? What was the most exciting thing that really pulled you in? Okay, year after year, okay, hey, this is getting even better than the year before this.
Yeah, I keep saying this to a lot of young people who join our companies too, that there's never a linear opportunity in any organization. There is always ups and downs. There were times when I was part of the organization that I felt that it is going nowhere. We were struggling. Things. Like some of the fintechs and founders. There's always a pain point in the business. But I think you stay through the grind. You put in your efforts because you are passionate to what you want to do. And then over a period of time, things play out, and success builds confidence. And as confidence starts getting bigger and bigger, you do bigger stuff and much larger stuff. So, I was lucky to be one of those very initial member of a team which joined SBI Mutual Fund and built it from kind of ground up. Quite a few of them still are there with the company today, who all are, today so committed to what at SBI Fund from day one, it was launched as an initiative to bring capital market expertise, the smallest of smallest.
Mm-hmm.
Now, it took us a lot of time to make that happen. Today, with crores of investors already transacting with it, we've partially been successful, but a long way to go. So the mission continues to be there of making accessible capital markets product to everybody. But more than the mission, I think the direction and the success that we are getting in that direction is what makes me more sticky. And not just me, many of my colleagues who've been around for the last 15-20 years. We probably have one of the most vintage people in our team who kind of
seen it all
together and seen the growth.
Oh, that is awesome.
Of course, there is a SBI brand. No, you can't beat a better brand than SBI. And there was a joke when I hired when I was in Bangalore SBI. When I hired a young guy from the market, CFA guy, and he was from Bihar. And one of the key criteria I asked him while joining, sir, I'm here to get married. And if I get married and there's an SBI in the probability of me getting a good bride is this is almost 20 years ago.
Yeah.
Very interesting how people look at careers, because things are different now. We are not just for the brand, we also do great stuff.
Sure.
So, yeah.
By the way, my father-in-law, when I moved to Bangalore, he asked me, why are you not working for Infosys? And the next question, when he came to know I have entered Fintech, he asked me, why are you not working for SBI? So it is very true.
That's true.
So, basically that's a good segue into what I wanted to ask, that you work for the largest asset management company in the country.
Right.
The macro is very interesting right now in the Indian markets, right? The whole world is looking at it.
Right.
There's like retail investors putting 30,000 crores into SIPs every month.
Right.
The mutual funds are sitting on record high, like something like 1.5 lakh crores plus, of AUM to invest. And seems like everything seems to be overvalued and PEs are very high. I wanted to ask you, like, what's happening in the market? What will happen? And are there enough good companies, good quality businesses to put this money into?
No, it's a good question. It's a question that we get asked quite often. And it's not just asked often, it's something that we always need to clarify, because India is at that stage when there's a big structural change that's happening. This structural change will bring some anomalies in between. The current anomaly of too much of money in the market, higher valuations. But if you look at some of the global developed market, they've all gone through this transformation, right? There'll be a stage where the risk appetite of investors will start going up. And as the risk appetite goes up, more money comes into capital markets. As more money comes into capital markets, the demand takes a while to catch up, right? It's a game of the ability for people to come to capital market to access capital market. So this is a little bit of a problem India is facing, but I think we will very quickly come out of it. If you look at the supply that's coming on the other side in terms of good company, whether it's IPO or pre-IPO companies that today we are already hearing, I think this is going to happen. Now the question is about valuation. Yes, we are richly valued compared to our historic valuations. But this is, mind you, the only large country growing at a significant, growth rate between 7 to 8%, and projected to do that for the next decade or so. If that's the case, I think the earnings will kind of catch up on this valuation. The question always is, what is the timing, right? Should I get this right? Will there ever be a great time? It's very difficult to say that. We've seen these ups and downs in the markets many times. Just imagine what happens pre-COVID, post-COVID. Nobody could plan it perfectly.
Right.
Having said that, in the cycle of the markets for the last 25, 30 years, there have always been few years when they are richly valued, and these richly valued markets tend to last for a few years, and then valuation catches up, or there is a significant correction. Right? One of those things would happen. And when those things happen, there is a potential for some of those guys who late entered to feel a little more disappointed. I came in last year, I was sitting on some decent profit, now those profits have gone away. So for such kind of investors, we tend to say that this is a long game. You're not coming in here for a one quick 6 months, 1 year kind of investment. Mutual fund tend to outperform the markets in a very long tenure, and more importantly, give you the capital market exposure, which today alternatively you don't get. So keep that in mind when people ask this question about too much of inflows coming into capital markets to mutual funds. So we have 1 crore SIP customers, right, who give us money. And we've never blinked an eye in saying that there is we'll service all those investors. But there are products like our small cap fund. We know that there is not much of supply and you can't do. So we've stopped subscription now for almost close to 8 years. Right?
Okay.
So we just take SIPs of those funds.
Wow.
So we have to be realistic where we can perform, we can add value to our customer. So the money, by the way, the biggest onerous business for us is the customer satisfaction. They need to understand what we can deliver before they come to us, and we need to deliver on that promise that we are here. Otherwise, this business is of no reason, no reason for people to give us money, because we don't give short return, we give market-related return, and that's a big difference. But thankfully, I think whoever have lived through this peaks and troughs have created wealth in multiples, and this is what is likely to happen in India. There could be some short-term issues, and then the question today is, what do you do? What are your alternatives? If you are investing, and it's a decadal investment, if you are investing for the long term, the capital markets is the first option for majority of our customers.
Right. In fact, it's very interesting. After COVID, most of the discussion when you sit down with friends and family were about health.
Right.
And those. And after 22, the only discussion which happens now in a group is about returns and asset allocation. And I saw one post of yours where you spoke about the shift from traditional savings into more diversified investment options.
Right.
And you said between 2014 and 24, FDs have gone down from 33% to 23%. Equity has gone up from 7% to 12%. And mutual funds, remarkably, have gone from 5% to 11%. That's like more than double. And this conversation is very interesting, right? In friend groups or family, that what should we do? And, a lot of people feel in a bull market that every strategy seems to be like the best strategy, right? Every investor seems to be winning. But then there are people who are investing 5,000, 10,000 crores as mutual fund managers who have experience and expertise. I always wanted to ask you, personally, I felt mutual funds have given me better return than directly investing into equity or FDs. Right. But this is like the most interesting conversation on where should you invest, how should you decide this mix. And your post was very relevant in that.
So the post was actually, for me also, those data are very interesting. Like today, if you think about it, I grew up when I was born, I'm the 70s kid. So the shortages economy, there was emergency the year I was born. Of course, I don't remember that. But then you had all kinds of issues with. So we were born at a time when risk appetite was very low.
Correct.
Right. Nobody wanted to. That every rupee mattered. Right. The value was very high. Today, that structural shift is very large, right? And that post was all about, if you see the last 10 years, the financial assets, in that today, capital market investments, mutual funds and equity are almost 33% of investors' money, right? So that is a structural shift. Go back 20 years ago, 30 years ago when I started my career, it was a different ballgame. There were just few sets of people who were able to speculate and be in the market. Today, the democratization has happened. More and more people now have access to capital market. There's one set of customers who are on those option trading and all that. That's not something I would neither recommend or so that's a different ballgame altogether. And of course, regulations are coming down strongly on that side of the business. But on the ability for customers to make money return out of their hard-earned saving is now easiest way to do it. Now the question comes of why in these, most people end up asking me, is it sustainable? Should I continue to do that? I think anecdotal evidence tells you that if you are an SIP for the last 20 years, you would have better off. Now the question here is it today markets are an all-time high, so you're valuing it at a very high. Go back to the all-time low market too, and take a 15-year data or 20-year data, you would have still made money. So what really happens is that people it is natural. Everybody wants quick money, quick returns. There's no such thing. If you're patient and if you invest for a long term, it makes sense. Second, I have a very interesting theory about where to invest. And this is a very difficult question. Now, honestly, if you ask me, you need to have some amount of liquid money with you. And then asset allocation is so critical that you don't want to be risking all your money in, I wouldn't say risk, putting all your money in investments which will take time to play out. You need to have some. So I say to all the guys who say, if you don't have any commitment and if you have long-term capability, put your money in assets which will give you long-term return. But if you have some commitment, if you're above 50, you're above 60, when medical expenses will come, when retirements will going to hit you, that's when I think asset allocation becomes very critical. And while you're picking asset allocation, then there are so many nuanced stuff, large cap, small cap, hybrid. But when you look at the distribution of return over the best asset class and the worst asset class in a very long tenor, these are marginal. It's impossible to get it right. Yeah. When you think about so ultimately, first and foremost thing people should do is stay invested in the capital market product. Then they can choose based on their risk appetite, whether it's a large cap, small cap, mid cap. That choice is secondary. The primary choice is to actually make investment. That's why SIP gives you a fantastic opportunity. Now, people say, it takes years and stuff. That's how wealth is built. The small money over a long period of time is how wealth is built. I have an SIP running with me for the last 28 years. So I'm just so happy that money that I would have put aside or I would have spent somewhere else today has been able to create crores of rupees worth of valuation to me because I've just put aside that money over a period of time. Now, again, wealth doesn't get automatically created. There has to be discipline and a little bit of luck and some amount of timing, but not a lot of timing. To remove the timing risk, you have to get into something like a mutual fund. So these conversations that today people are having, is it worth investing? Should I invest more? I don't think it's an actually important question. The important question is you have to invest, but what's your right asset allocation? Right asset allocation is there are lots of ways to do it. Simple way to do it is age-based risk profiler. The other way to think about it is that you already have what kind of liquid assets, what kind of real estate exposures, commodity exposures, gold at home, things like that. So the one single view of is need to be taken before somebody jumps in and says buy this or buy that.
Is there a calculator online that people can use?
There are a few of them. Like for example, there is an age calculator. There are some in our website also. But there are some fintechs which have very good calculators with more nuanced approach to your cash flows, your commodities. They are there, but I think my suggestion there is if you really want good advice, talk to somebody who can give you one. Apps can get you 80% there. Self-service can get you 90% there. The 10% can happen only two ways. One is talking to people, advisors or friends who have done it well. More importantly, doing some research, reading up on it. There's nothing better than reading up on personal finance because there's lots of stuff happening around that. And you read up on it, that 10% makes up. So So then I think the portfolio becomes much more better. Your conviction about what you're doing gets better.
Got it. Being at the helm of such a big fund, I had just another question before we change the segment. You mentioned asset allocation is important. We'll come back to that a little later. If, say, a retail user decides to go ahead and do an SIP, today they have a lot of options, right? Not taking names, but what are 3 things they should keep in mind in choosing the right fund or the script to go and put their money in?
Retail investor script is a wrong thing. Fund
Okay.
definitely, I would say. Generally, the basic principle of looking at choosing a product has always been first and foremost. I will say that at some level you need to build confidence in the manager that you're giving money to, even before the product that you're buying from the manager. Do they have enough vintage? They have successfully proved their track record? Have there been any major complaints against that asset manager? Have they been caught with some regulatory strictures in the past? These things matter because some of those things will rub off in the way the portfolio manager manages. The second thing that you need to see is are they reasonably large enough, not very small, large enough, because the larger they are, the efficiency of scale is kind of passed on to the customer. While the regulator has a regulatory cap, but the bigger the asset manager, lower is the expense ratio, and as lower is the expense ratio, better is the derived understanding, the better is the performance. So they're not necessary, but it is better. That's the second part of it. A good quality fund manager, which has all the good track record. Second is the reasonable size of the product that you're buying. And the third then obviously then boils down to some track record of the product itself that you're buying. Does it have enough good quality track record? Have they added value? During bad times, how they perform? During good times, how they perform? What is their correlation to the market? Some of these things are available to read up on. There are lots and lots of data available on the internet. You can go, some of these fintechs have some very nice comparison capability. You can do that. You can also go to websites today. Regulator also is pushing us to do more and more of those disclosures. So those disclosures are available.
Right.
Included, if you go to, let's say, an SBI Mutual Fund website and you click on a fund's name, the amount of information you are bombarded with is so much. So today, thanks to AI, you could just run that in an AI and actually say, okay, now I can't read 20 pages. Now you just compare all this and give me a highlight. Has this portfolio management consistent?
That's a great point.
Or there been changes in the portfolio managers that's there? Those insights can come.
But you have to have time with you. If you don't have time, and if you're like, I'm already 50 plus, and then I'll invest for next 20 years, but I have a lot of other things to do. That is tough. That's tough. Earlier is a huge advantage, and all the millennials have great benefit today. Something you should always do, because that money you would have spent. Today, a Starbucks coffee costs you $350, right? 3 Starbucks coffee in a month is 1,000 rupees. 1,000 rupees SIP over a period of 20 years at a 12% return can make you a lakpati in Millionaire, Indian Millionaire. Right? But I'm not saying don't have Starbucks coffee. But if you don't have Starbucks coffee, I won't have company to invest in.
I need both. I need consumption to happen. And
Correct, exactly.
Both have to happen. That's the wealth effect. The more wealth is there, the more consumption will happen. More savings also will happen. So it's like rotating.
I think then one discussion maybe towards the end of it is also, if that's the case, then we also need to discuss how is wealth going to be created for bottom of the pyramid, bottom to middle of the pyramid.
That's the mission we have.
At SBI, that's a mission. We are very clear that why we have 320 billion, and I don't want to touch that upon, 320 billion assets under management. Like at scale, we are among the global asset manager scale. Wow. We are going global now. We are taking our capability outside India with Gift City, Singapore, Dubai, and many other plus. But at the core of it, what we want to do is democratized access to capital markets to the lowest set of investors. So that's a mission. That mission, not just me, many AMCs are trying, but for us, it's a core mission, it's an SBI kind of a DNA. And the only way to do that is to get this message out, get more and more people taste the product, get used to it. Digitization has definitely helped. Right. By end of this month, hopefully we will have a 10 crore folio base, customer base at the industry level. Wow. But it's going to still take a long, long way before more and more people come up. But we are fighting a battle of 2 things. One is the legacy of contractual return, People are very happy looking at their books and saying, I've got nice 6% return from my bank account. I don't want to risk with that money, which is fair. I think some of the customers should do it, investors should do it. The second thing that we are really facing is a lot of unstructured products out there, right? A lot of these chit funds and things like that. So the unorganized sector actually does a lot of that, which is on the bottom. Nobody gets to see that. And they lose money. And when they lose money, they have nothing with them. That's a huge problem. So we are now embedding products into government schemes and stuff like that slowly. Like EPFO, I want to talk about it. One of the biggest thing that we have done as SBI Mutual Fund is to get 8 crore customers of EPFO investor capital market access. Till SBI Mutual Fund came into the picture, it was all invested in bond markets. And the return were, whatever bond return gives you. Today, at least we have created 3 to 4% extra return to those 8 crore customers. Because we pushed EPFO to invest in the capital market. And they started investing in our index funds, right? And that now is what? 2 lakh crore of money that they've invested. And just imagine the benefit. The markets have gone up, even if it goes down 20% from now, all of them have made money.
And if they open it up to the investor, then like 401k in the US,
it is.
It will be insane.
Indirectly, we're doing the 401k in India. Directly to nahi kar rahe. Karna chahiye. NPS is there for that. We have a subsidiary company called SBI Pensions, which looks at the pension business. But I am very proud of what we at SBI Mutual Funds, me and my team and my colleagues have been able to convince the government to make them invest in our ETFs, right? And thanks to that, today 8 to 10 crore Indian citizens, right, have the indirect capital market access. Even they have no mutual fund and all, their money has gone into capital markets and they've made lots of money out of that. And they'll continue to make, right? Because that 20%, that 15% invested of your money through EPFO in the capital markets is now continues to give you money. Now, globally 401ks were way to go. People were self-going it. Now things will change. We can talk about that.
Srinivas, one very interesting point you mentioned was this shift entirely that's happening, and access to some of these mutual funds for the younger generation is coming in the digital way, right? Powered by some of the investment apps that are coming through, lots of wealth tech startups coming through. I don't think this sector was as hot even a decade ago. What has really shifted? Some of these businesses are AUM businesses, but raising venture money. So, just given the length you've had over 3 decades, what has really shifted in this decade, and what makes it so prominent? Where's the opportunity lie here?
No, I feel the COVID has changed the entire wealth management specs, because the rapid digitization has kind of helped all these fintechs come up with propositions which makes access easy. So as of now, most people have built high quality access, which is good quality journeys for the millennials out there, the digitally savvy customers, and even regular investors. They've been able to ride on the DPI architecture that's there. They've been able to ride on access to capital, like most of us have created API architecture, which they kind of pull that and have built it. But what they now need to do is to really build value accretion. At this point of time, it's pure access. They've built very good quality access, and thanks to that, we've been able to get millions of customers as an asset management industry. But they really now need to build on top of that and add much more high quality value. Some of them are doing. In fact, most of them have plans to do. But it's going to, some of them have to come up with a high quality value proposition beyond just showcasing products or bundling some 1 or 2 things, but they have to really add value in the customer journey. And once that starts happening, I think these fintechs will start growing. Another thing that's a downside to the fintechs, which they need to work on, is this faceless, selfless kind of stuff in financial product is very tough. We are a trust-oriented, entire financial services is a trust-based model. Now, how do you bring trust in a faceless kind of capability? It's okay when you're making payment because there is a bank behind it. But when it's wealth, then there's a little difference. So we now need to address some of these larger challenges, and how do you deal with market movements and the education that you bring into the people. So it's a journey, but I think today we now have the potential for a lot of fintechs, especially wealth tech and invest tech capabilities, which is going to scale in coming days.
Very interesting.
Yeah, maybe this might be a good segue into a B2B sort of a discussion towards financial services. And
Right.
I think we had a couple of conversations before about like you have been responsible for automating processes in SBI Mutual Funds, also digital innovation.
Right.
And there's a, from a B2B fintech perspective, we always look at banks and financial services. And I'm now spending a lot of time on the AI side. I wanted to ask you, like, what is the opportunity for B2B, fintech companies today? What are the things that you really want to automate now going forward?
Yeah, the problem with B2B, and this is a issue in India, is what needs to be built is largely built. And this is not, this is good because, you get, the DPIs have created a lot of these infrastructure which a B2B company can today say, I'm a great aggregator, or I have this capabilities to build a SaaS layer where more people can join in. However, what has not happened is the TSP layer can do a lot more in terms of bringing costs down. Today, the economics of the model, let me look at mutual fund industry. It's a highly regulated cost industry. The operating cost is significantly higher compared to the management fee that we make, right? So for me, as the operating cost starts going down, the ability to scale go up. Today, the challenge is what regulator and all of us are also now really trying to do is, how do I get the real bottom of the pyramid customers, 50 rupees, 100 rupees, 250 rupees kind of customer, when the average tickets for the industry is in thousands, in fact, lakhs of rupees. How do I bring that down? To bring that down, innovation is required, especially B2B SaaS providers at the unit economics. And if you crack that unit economics, that you can do scale, but at the fraction of a cost, then I think there is a lot of ability. And there are ways to do that. And people are trying to explore how this can be done. But we have integrated so many things today. It is now at every level you need to bring in higher efficiency. And you start bringing at every level higher efficiency, then you have a great value product. And that product can scale. And today we are, we're very happy with 1 crore, 2 crore SIPs. But I think if we are having tomorrow 25 crore SIPs, I will not be very surprised, because we would have solved for the unit economics. Today, the 25 crore SIPs is impossible to manage, because it will become a headache for SBI Mutual Fund, because every SIP costs me between 20, 30, 40 rupees to service. Right? How do I make that in paises, so that those paises will lead to more people coming in, and more people coming in will democratize access to capital markets.
Can you help us break that down? You mentioned, okay, hey, operating cost, if today it costs us X, if we need to bring it down to, allow more people to come in, then we need to bring it down to the, levels where they can enter at 100, they can enter at 200, 500. Yeah. What are the major opportunities that lie here? If you can help break that down?
So the opportunities are on the payment side, opportunities on the aggregation cost side, technology provider side, or on the KYC side. So if you break it up, there are 7 or 8 costs. Those costs can be a good value player can think about all those costs and say, if it costs you 10 rupees today to get all this done, can I do it in 2 rupees? And if I can do it in 2 rupees, what is the volume that can come to me? The volumes are there for the making. Large asset manager like us really want to do that. And by the way, we subsidize today. Every single 100 rupees SIP that comes to us today is a loss-making SIP, right? So, but there is no incentive for me to do more of that. We do it as a social good. We do it because we want that 100 rupees investor to eventually have 1,000 rupees and a 2,000 rupees value. But if that doesn't happen on a standalone basis, we lose money. Now, if I don't lose money, I'm completely incentivized to do only 100 rupees SIPs. That means I'll actually now improve my penetration, and that will just take this business to the next level. And that's what happened with UPI. That's what happened with the entire payment industry. It's just a frictionless, low cost. Now, people have a problem with MDR, right? That discussion has been going on for many, many years. That is this value accretion. Are you destroying value by doing all this? But I think we have also done a lot of social good. Thanks to UPI, there is an economy which is significantly higher. There are people saying 1 to 2% of the economy can be attributed to digital payments, the efficiency in digital payments. So it's a big number.
One area I always thought that outside of DPI, which nobody is building and could also impact the cost, was the overall like the OS of running AMCs, right? Like,
The RTA business.
right?
And,
Can we come out of the duopoly and if can then there be innovation around the like this core banking? Can there be like this core investment platform?
yeah.
Nobody has thought this through from a ground up, because we have, like, if you think about asset management business, when I joined this company, it was the RTA was supposed to be largely a data entry operator to maintain units of customers. But slowly we started dumping onto them everything: customer servicing, branch access, transaction, accounting, calculation, valuations. Now with so many regulatory requirements, so it started stacking up from there. Today, you obviously cannot live without RTA. These RTAs and maybe the potential new RTAs need to rethink the whole business from a ground up kind of a capability. And once that is done, there are some people trying to attempt doing that. Then I think there is an ability to create the so-called OS that you said, model around this, and that will also add a lot of efficiency. And that could be the next big tech person who can see. What we have tried to do is we've distributed our problems. Our problems have moved from RTA to let's say an exchange platform, or today an EOP, or our fund platforms. But they are just investor onboarding challenges. There are other things that we need to crack as an industry, post-investment onboarding. And that is something, there is a lot of new things that can happen there. We don't have a depository equivalent in mutual fund industry. We have, there is a way to rethink the current architecture. Maybe tokenization, as it starts becoming a critical, maybe it's too early today, could also solve for some of these things.
That would be super interesting.
Yeah, so Finternet, what Nandan and everybody is talking about, is actually trying to reimagine how today the entire processing can happen. If you can think about everything going through a token environment, a trusted token capability, then you really don't need a single entity to do this, because that block has all conversation, all stuff that's there. But it's a really long shot. It's going to take a while.
Well, I think that'll be very interesting. I think if they can build architecture, end of the day, I think the technology is very interesting, right? If they can do it at the scale that the industry is at today, and in a secure way, in a proven method, I think that'll change a lot of things.
I am sure if anybody can do it, India can do it. We are today, the way, the innovation and the space at which it's growing today, at least in our space, I think 5 years from now, I will see some really big, large initiatives. We ourselves are actually encouraging many of this, including sitting into debates, giving them ideas. That's some of our role to both the regulatory level and also fintechs and policymakers and thinkers. At least I've been part of many of these conversations, which I think will start showing up in the next few years.
Nice.
Talking about large scale, I know you are on the governing council of Global Fintech Festival. You have been there since the beginning, and this time GFF was huge. It's the largest fintech event in the world now.
Right.
The question is that in this event, what do you think were the 3 biggest ideas that you saw, or things that were the key takeaways for you?
So there are a couple of things that I think the GFF has evolved to today with almost 100,000 footfalls. It's a huge event. It's a massive event. It's a marquee event in the world of fintech. And I don't think anybody, at least in India and now globally also, who would not know about Global Fintech Festival. It's really become that big. And this year we had a Prime Minister also come and talk about and his vision on what India has to do from a fintech point of view. It's a fantastic way to think about it. But this year, I think we've been able to achieve few things much more significantly. One is on sheer product launches. This year we had one of the largest amount of product. Hundreds of products got launched during Global Fintech Festival. 2, I think from a policy and a regulatory discussions point of view, this year was a marquee event with RBI, SEBI, IRDA, PFRDA, all of them actually being present very actively. They've been around for a while, very actively in terms of infrastructure. Like there was a discussion which on SRO, which is now matured, and there are more things happening on that side. SEBI came up with a lot of new initiatives this time in pre and post GFF. But I think the biggest thing that I saw from a takeaway point of view is basically the event has now really gone global. I could see a lot of global investors who came in for this particular event, largely trying to understand the Indian fintech ecosystem, how, and I know lots of great conversations have happened. Hopefully, this will all result into some good equity coming into India. It happened last year in a big way, but this year I'm assuming that could be much larger. And some of the fantastic innovations in new product launches, like the UPI product launch that happened this time, there were a few products, but some of them are just out of the world. I think this time it was a lot of DPI showcasing that we did as part of the GFF. Also, while we talk a lot about product launches and all these marquee speakers, what really gets, for me, the most exciting thing of GFF is the show. You go down and you see the buzz of excitement, the amount of people. It's a little bit of a mela, but high quality mela with interactions. And what I loved is I spoke to quite a lot of people who had their stalls this year. And many of them came up and says, मेरा 2 year का order book is done now. Some of them were saying, I don't know what to do now, I have to hire. There's so much of business. So there are lots of such great stuff, conversations that have come. Of course, as part of governing council, we are also worried now this is becoming now a lot of footfalls where now we need to give a better quality experience to people. So we are working towards making it even better when it comes from next year's point of view, using technology, doing stuff like that. AI was one of the biggest themes this year. We had very interesting conversations around the future of AI with fintech, and there were very interesting conversations around the entire blockchain work that's happening. There is this time a lot of thing on quantum. You now started seeing really cutting edge discussions happening in GFF, which was largely more around policy, business and things like that. Now you started seeing pure, I would say, technology spoken. Of course, ONDC had their large launch, and for mutual funds, there was a ONDC mutual fund event also. There's quite a lot this year that happened in GFF. So I think the maturity of the GFF has gone up significantly. I think it's definitely a marquee event.
Srinivas, it's interesting you mentioned AI. But my next question to you was a little bit of a bouncer. We spoke about asset allocation earlier. If choosing what to invest in is a lot about numbers or a lot about research, and if AI can do that well, maybe not as well today, but say the way it's progressing 2 years, 5 years from now, the models are going to get a lot better than what it is today. Do you think there'll be a point in time where they will be able to allocate money a lot better than fund managers today?
I hope not. I won't have a job then. But on a serious note, there could be. I really don't know. There's so many extreme cases that can come up to. But the fact is, if AI is for good, and if AI is used for a good purpose, there is absolutely no problem in that. The question today is that if you're using AI as an arbitrage to do things because there is inefficiency, that will go away because everybody will have AI. So you still need to have something which is of real value as a business to propose. So human beings are the real value. We are a knowledge company, but we are assisted with technology, right? AI will assist us in a big way. We are already at SBI MF been using this for a while. So we have a front-end investment management tool called Neo. It's been around for now a couple of years. We use quite a lot of modeling there. The idea is to be an assistant. We don't want to run a portfolio on a model because that human touch is today very critical. There could be a period, and that I'm not ruling out, an AGI kind of an environment where everything learns on its own and we are on basic income, happy, with what we have. But that's still more, I think, at this point of a utopian requirement. For the time being, for at least maybe next decade, I could say, we will play an important role. a human being will play an important role. We'll be significantly productive thanks to AI that will do. So our tools today we are using is largely to do that. Better decision making, better productivity, better discovery that I can do. And those are largely arbitrages at this point of time. And when that arbitrages go away, it still will be human being. Everybody will have.
Right. Even Morgan Stanley is one of the first financial institutions in the US which has directly worked with OpenAI and launched the first version of their product, which is meant for their wealth advisors.
For their wealth.
For them to use, whatever information they need.
Assistance, the co-pilots would be the way to go in for the next few years. And over a period of time, product ideas would start coming thanks to this, and there'll be much more significant stuff. So we are experimenting. We are not saying no, but we are not getting carried away by saying, AI is the future. I don't think that's the way to think about it. But as a very large organization with $350 billion worth of assets that we manage, we cannot say no to a technology change, that shift that's happening. And we are investing, and we are, today we are running we parse a lot of publicly available data, which is humongous, through an AI model to give us at least news flows, sentiment analysis and things like that, which are basic stuff that's required for a portfolio manager. His now is more narrowed in how you do this. Sentiment analysis is something that we do fairly, thanks to AI. We are a very large ESG player. So ESG is a very complicated thing, looking at, and there's tons of data points out there. Using AI is kind of, helping us build better models out there. So a whole lot of use cases there already. But my feeling is it's going to be more of a productivity tool. It's going to be more of a decision-making tool, but it's not going to decide for us.
Correct. I think the quantitative parts, the research parts is where AI comes in and assists you. But where the human element probably might not go away is a lot of your decision-making, I think, is qualitative as well, right? I think there are some decisions where, sometimes, you can call it gut, you can call it other ways, but you really need to know the management.
Experience, right? I've managed, let's say, my portfolio manages a product for last 20 years, and even if you take all his wisdom and understanding and put it in a model, well, the model may be faster than him, but won't be as wise as he is. That wisdom comes out of his 20 years of experience, the human intuitiveness. But there's one use case where I believe it's going to change dramatically, is not the investment management skill, but our user interfaces, our user interactions, they will significantly go up. Let's say our app architectures, our interactivity with our customers, our ability to parse information to them, give them real relevant information rather than throwing up pages and pages of document. These things will actually significantly help us. If a customer is coming to me and wants to know about something, today when you look at our chatbots, it's a very transactional chatbot. You ask a question, there is a curated answer that comes to you. But the context window, we're now building one Llama 3.2 model in backend. It's a prototype which in GFF we kind of showcased it. The interactivity, the ability for the LLM to parse your understanding and give you relevant information, more contextual and relevant information, that thing will now go up like anything. So our ability now at a productivity level to make sure our customer conversations, our partner conversation, and a B2B2C kind of channels, those things will go up significantly. And this is how we moved from that internet world to now we're moving to a more AI world, because everybody will get used to tapping a button, talking to the phone, and getting some inputs. It's going to happen. So when we were the first people to put all these voice bots, right? Alexa, OK Google, all of that stuff as part of our, we built this some years ago, but nothing happened because the backend was not very strong. You are just, getting very passive, responses. Now, thanks to LLM, you can now get very active and high quality interactions. That will help. And just one button on your app, which will power users know what to do. The guys who don't have any idea will just click on that one single button, and it will be able to, through whatever conversation you have, able to get it. So I think that's how powerful AI would be from a conversation point.
Right. And just one thing to add, a lot of mundane tasks are already going away, like creating emails, setting up meetings, a lot of these notifications, that's already going on.
And things like one of the things that we are doing because we are a business entity. The regulator is already using it significantly. SEBI, we've done. In fact, GFF also, we talked about it. We've done some hackathons also. We are now using SEBI is now using a whole lot of AI led stuff to catch. Like some of the bad influencers who are using wrong data, because that's a big problem for us today, right? Misuse of information, wrong information being spread, catching it very early. They're using to understand let's say, the way to put it is that they want to stop, they want to understand what's happening and give relevant information at the right time. So there's a lot of work the regulators are doing. RBI is doing one, SEBI is doing one. So that there also it's going to clean up the ecostructure, makes the market more efficient. Thanks to LLMs.
Srinivas, one of the next questions I have is, say on a personal level, you had an extra 1 lakh to invest in the market. How would you personally do that? That is okay to go into that. And off the record, another thing, see, at a retail level, we have only very little money to invest. The fear is at that level, right? But when you have so much money, isn't it really scary at sometimes when you're sitting on so much money? Like, how do you manage risk at that level? Like, that's why I'm asking it off the record. Because I'm like, if I had even 1,000 crores to invest, that seems like such a big amount. You guys are sitting at like 320 billion here.
So what happens is that if you run it professionally, you don't have to worry.
Okay.
If you don't run it professionally, you have a problem. Today we have 180 people in our investment risk management team. Each one of them, we run it highly templatized, highly scientific. We have investment committees looking at the macro side of it. We have risk committee looking at the risk side of it. And we are nothing. We are just 320 billion. BlackRock is a 6 trillion asset manager, right? I mean, I'm like, just think about how they must be doing, right? So I don't think scale is a problem. Problem is not having efficient, good quality talent, technology pool, processes to make it happen, right? Every crisis we've learned and we've got better. We've added new processes, we've added new structures, we've added good teams. Right? Today, our risk team and compliance team is probably 10x bigger than what it was 5 years ago, simply because it's need of the hour. When you start scaling business, fundamentals, you have to get it right. The fundamental is not just about investment skills, risk management skills. You get the risk management skills. Now, the next big thing for me, and I'm working on that project I talked about, is operating efficiency. Bring high quality operating efficiency so the benefits of scale is passed on, and then you continue to scale and still be profitable at the same time. Anybody and every investor who come to you, you start making, we are not in the business of margin expansion. Margin contraction hai, but it's a scale expansion. This is a clear trend that we're looking at.
What would it take for a 320 billion to reach a 6 trillion? Like, is it just a matter of time? Is it a matter of markets?
It is a matter of time and markets. It's a matter of capability. So all of these things.
Is there in India? You're seeing
not yet. We have to groom. These things will come with maturity. These things will come with asset classes growth. For example, BlackRock does fixed income at scale, which is like they can buy a small country, right? That's the kind of markets they have, right? The size they have. And of course, they have a lot of political connections. And once you reach to that level, it's also, for example, they have a lot of pushbacks in US. Some states have, because they were trying to do something on ESG in a big way. Some states in US actually had some issues with them. They pulled out their portfolio out of BlackRock. Then these guys had to go. But there are lots of stuff, and we are talking off the record. But there's lots of stuff like that. For example, SBI Mutual Fund, I can tell you off the record, we are so large today that the government comes to us and says that, "Bhai, ठीक है, थोड़ा social service करो." I said, क्या करना है? एक industry, we have set up a fund for the industry called Backstop Facility Fund. We run it like a free for the government and everybody else because we believe that will help the industry. That's a small cost that I pay for keeping industry safe. So the Backstop facility is like this. All the debt funds that are there in the market, non-equity, debt, bond. This happened when Franklin Templeton went kind of into very. So the government called us and said, "Aapka ideas kya hai?" हमने बोला, let's work on how to build insurances to failures. right? That was the concept that I was trying to push at that point of time. Then government itself came up with the saying, okay, what if I can give you some money and use that as a leverage to do a backstop? Then we said, agar aap free mein paisa dete ho, to people won't work for it. We'll also have to contribute. So we ended up coming with this concept called CDMDF, where every fund, debt fund, gives 25 basis point of their AUM to this fund that we have created at SBI MF. That itself is 30,000 crores. And that corpus is created. With that corpus, I take another 10,000 crores from the government. That 10,000 crores can be leveraged 3x. Now I have a fairly large corpus. Now, whenever there is a market disruption, let's say bond markets correction happened, bonds are good, but the markets are very uncertain. Now, there is a run on let's say Templeton had that. There was a run on the Templeton Mutual Fund. And that point of time, the Templeton Mutual Fund could not sell its asset, right? So we were called by the government saying, "Aap usko take over karo because you're big enough now. Take that asset, settle the customers, then you can sell those assets and give it back." So that's what we did. Now we don't want again SBI Mutual Fund coming and rescuing another asset manager, right? That's not our job, and the market should not happen. Why not create an eco structure which can help? So we created the CDMDF. Today we manage that fund at virtually no profit. But the point here is that we've been really trying to improve the market architecture and eco-structure, which can then help not just me scale, the entire industry scale. Yes. The investments that we have done in, we have now a large API stacks. We're pushing government, what we call a central mutual fund schemes. All of this is basically meant to ensure more and more asset managers can benefit from all the capability that we have put. Mm-hmm. And when we it's an indirect DPI. It's not a DPI, but the efficiencies are now getting done at a industry scale. And that is how you get to 6 trillion. It's not because SBI MF wants to be 6 trillion. It's the efficiency has to get better. Today, if you want to invest in a bond market in India, there is no liquidity. No, we have to create liquidity. SBI Mutual Fund should be the spearheading and creating that liquidity.
Srinivas, entering the last segment, one interesting question I've always had at the back of my mind is our generation has never really seen a market dip. There was a blip during the COVID time, but I think it bounced back really quickly. In your tenure, you've seen multiple such cycles. The last one I can probably remember might be the one in 2008. I know it is very, very difficult to plan and predict, but just given your lens, what are some things that we can take care of? How can we be better prepared if there is something like this to come in the coming years?
No, there's absolutely no exact science around it, but there are certain things that people can follow. First and foremost, never let your portfolio leverage beyond a point. I think leverages kill all this stuff, and today people are leveraging quite a lot to get those short-term returns. Leverages are important when have certainty in the market, like you can predict with 100% certainty. Those things are impossible in any of this market. So I think over leveraging on the portfolio is a wrong thing. 2 is a well-diversified portfolio means that it doesn't matter if one asset class is doing badly, there's something else or the other which is doing well. Especially during, let's say, in 2008 when the global financial crisis happened, there was one asset class which was doing very poorly. There was another asset class which was doing very well because they were defensive hedges to the currency devaluation or economic downturn. That's the third thing is that nothing lasts for long. So these crises come and they stay in for, let's say, a couple of years. There'll be policy interventions. There'll be, liquidity that will improve over time. And then there's a revival. Even Japan market after 30 years have revived. Today they are on a peak which they didn't see for 30 years, despite not doing extremely well economically, but they've revived, right? So I don't see, anything lasting for decades. At best, couple of years or 3 years when things like this happen. So even COVID, such a large disruption, the market dislocation was like few months at best. That doesn't mean that people should be, taking all kinds of risk. Asset allocation, playing it out. And of course, when events happen, when there are certainty of bounce back, doubling down on your capability, depending on your risk profile. Sure. Obviously not to put all your money because you can't time the bottom, but doubling down on that. That's when money is actually created. Warren Buffett has this very famous saying that be greedy when markets are markets are negative, and be bullish when markets are be negative when markets are bullish. So it's a very important thing, but it's played out for many people. And then the last thing that's very critical is that, and I think if you take a decadal view, if you take a multi-decadal view, at least Indian investors, I think the ability for India to outperform globally is so high that we will definitely be one of those markets which will bounce back much faster than any other market if the crisis happens. So you've got to be patient during that particular period. And if you're patient, I think that pays out in the long run. And spread your investments through routes like SIPs and others, rather than come in lump sum. And then the point-to-point return is always a problem. Rolling returns are the best way to look at it. And the only way to get rolling return is invest through the market cycle, right? I think the millennials have not seen, as you said, this cycle. And I hope when the cycles come, they don't get very worried, because if they've done their asset allocation right, I don't think they have to worry too much about it.
Srinivas, I know portfolio allocation is very subjective to each one's time in their life, how much risk they want to take, etc. But say on a personal level, you had an additional 1 lakh to invest today in this time period. How would you split that given where you are today?
Again, that's a very difficult question to answer without understanding the context. I don't even know. In my case,
Sure.
I know my investments where I've already invested, so I know where to invest.
Sure.
But I think the general thumb of rule is that risk capital, let's assume, needs to come out of your well-planned both current assets that you hold and future potential revenue that you have in mind. If you can get that right, then it's a question of where this 100,000 rupees is going. My way of thinking about it is that if you feel that you don't need this money for the next 10 years, then I think, and you have other cash flows available to manage liquidity, I think equity markets are the best way to invest today. And since I'm assuming this is new money that's come to you, and it is disposable, and because all of these are ifs. I think you should think about proportion of that in index-based investing, proportion of that in a multi-asset portfolio, and something in a little small amount in something like a high-risk portfolio, because you have a long tenor to play out. So that is kind of spread.
By high risk, do you mean the newer asset?
Thematics and let's say small caps and stuff like that, because they have the highest potential of return, but they are also the most volatile. So you don't take a large risk in that, but they do tend to give a little bit of boost to your overall portfolio. But if that's the only portfolio you have, then you have a big risk. So you got to have that in it's like a big thali. You need some different food items in the thali. There is sweeteners, there are chakanas, and there are all kinds of stuff. So small cap is one of them. Thematics is another one of them. You play around with that.
Got it. No, that's very interesting. No, for sure. I think definitely very subjective, like you mentioned. Lots of research available today online. So I think,
but there is absolutely, and I always encourage people, don't go by what I say or what some influencers say. Do a little bit of research. It's your hard-earned money. If you have 100,000 rupees, spend 5 hours searching on the internet, reading about, there are some very nice personal finance books. Read that, and you have to read that. Financial skills. My daughter is in a university now, and I was so amazed that they have financial literacy as a compulsory course in that university, right? It's because that's the only way she will shape up, right? And once people teach them what is financial literacy, digital literacy, they are much more better than people with money, because they don't know what the hell to do with that money unless somebody gives them a good quality advice. Of course, when you don't have that research capability then go to an advisor or go to one of those research portals and do that. That's when you should invest.
I think it will be appropriate to sort of end this discussion, which is a Fintech podcast, with a Fintech question. That if I may ask, like, which are your favorite Fintech companies or apps out there?
Yeah, that's a politically different question to answer. But they have been around. I mean, there are, so that you can bucket them in few things. Apps that are helping me solve for a problem. Apps that have great user interfaces that you use for. They don't have a problem solving, but they're fantastic place to go because they are user interfaces problem. The third one is the ones which are complementary, like a banking app, right? A good banking app helps me. I'm not going to change a bank because the app is great or the app is not great, but it helps if the app is great. So that's the way to think about it. So I don't want to name names, but off late I have been like on the payments. There are few sets of apps that I use, which it's like, whether I don't even want to discover. But there are some very interesting, like there's a friend of mine who runs this app called Kiwi, which is a UPI-led, which is very interesting app, right? It's a very, you kind of like the way, then the one card guys, they do a very good job on the credit card side of it. There are some few of the apps which for me it's a go-to because I kind of like their interfaces. I kind of like the small solution that they're solving for me, which I can't get it done in a bigger app. But my principal app obviously is my bank's app, which is YONO, which for everything that I go because all my money is there. And of course, my own SBI Mutual Fund app called Invest app, which I use for all my portfolio management because I put all my money in my own fund house because that's the skin in the game for me to do that. But there are some like fintech apps that I use, where I do some data discovery. But off late, I think most of them have started looking the same, giving some similar services.
Yeah. Is there a product that you wish that existed today? Sometimes, you might have come across a problem like that or an idea, but you're like, okay, hey, I wish something like that.
No, so I think there are lots of ideas that can exist, but I think what is today missing is, and I am incidentally also on the governing council of Account Aggregator, and we're trying to promote this ability to get one view. Today, my challenge continues to be whoever is offering my solution doesn't know me well. And that is a big challenge. And I think thanks to now the account aggregator platform and our ability to pull data out of multiple financial data sources, I think eventually you will have a very elegant platform. Today, I don't see that yet. There are bits and pieces. There is something for credit. There is something for PFM, something for something else. Tomorrow, I'm assuming there is going to be an elegant platform or a AI model or whatever you want to call it. I don't know how this will evolve. Where I think I must be able to talk to it and get my financial well-being understanding through that, rather than go to 10 places to solve for 10 things.
Yeah, a single platform, a single view for.
And I'm sure with this, the data ability for me to structurally share data through AA will actually move us in that direction. Right now, those AA use cases are built for credit, PFM, and very specific use cases. Tomorrow, it could become a more 360-degree view that can help. And I hope somebody cracks that and builds a very good interface for that. And AI on top of it.
No, I think this discussion will go on forever. There's just so many nuggets that will come out from you. But thank you so much for joining us today, Srinivas. This was absolutely awesome hosting you.
All right. Thank you.
Thanks, Srinivas.